Here's a projection that scared a lot of people. A 35-year-old on a good income, maxing her super every single year, and on a strong fund, the $3 million super tax catches her at 59, 1 year before she can touch a cent. That maths comes from the version of this tax you were warned about. It is not the version that became law in March, and almost every video about it was recorded before the rewrite. So today, the projection rebuilt under the law that actually passed. Where the line really sits now, the per-person quirk that treats couples and singles completely differently. And the uncomfortable way a 30-something actually meets this tax. Because it isn't by saving. Quick one first, general information only, not financial advice, and super rules span decades. Assumptions do a lot of work over 25 years. I'm not licensed, the numbers are illustrative. And nothing here is a promise about what future parliaments do. Rewind, 60 seconds, 4 facts, then the projection. When this tax was first proposed, 2 features made it genuinely alarming. It taxed unrealized gains, paper profits on assets you hadn't sold, which had self-managed funds, holding farms, and business premises in real trouble. And the $3 million threshold was frozen, never indexed, so inflation would drag more people over it every year, eventually reaching people who are young savers today. Both of those died before it passed. The final law taxes realized earnings only and only gains made from mid-2026 onwards count. Both thresholds are indexed to inflation, the $3 million rising in $150,000 steps. What survived, balances above $3 million, pay an extra 15% on the earnings attributable to that slice, roughly 30% all up, and above $10 million, a further 10 points on top, taking the headline rate to about 40%. The first test, your total balance across all your accounts on the 30th of June 2027, with the tax itself calculated on realized earnings through this financial year. One disambiguation, because the comments will mix them up. This is not Division 293. That's the existing extra contributions tax above $250 of income. Different tax, unchanged. Now the projection. Sarah, regulars know her. 35, 150 grand, Sydney apartment. Her super sits at about 130,000, about right for her age and income. And because a few videos back we showed super's tax wedge is the strongest one she has. Let's give her the most aggressive legal plan there is. She salary sacrifices to the full concessional cap, every year for 25 years. Cap rises with wages. Her fund net's about 6.2% after fees and taxes. Assumptions on screen, argue with them in the comments. If anyone ordinary hits this tax, it's the person maxing for 25 straight years. Right? Here's the race. By 40, Sarah's at 340 grand. By 50, 1.1 million. At 60, after 25 years of maxing, $2.77 million. A genuinely huge balance. And the line, because it's indexed, the 3 million threshold has been walking away from her the whole time. By her 60th birthday, it sits at about 5.85 million. She doesn't cross it. She isn't close to crossing it. The gap is over $3 million, bigger than the threshold everyone was frightened of. And before anyone shouts in the comments, yes, those are future dollars. That's the point of indexation. In today's money, the line stays parked at roughly the same 3 million it started at, and Sarah's 2.77 is about 1.4 in today's dollars. Not close. Crank her fund to a hot 7.5% net, 3.37 million, still a couple of million short. On employer contributions only, no sacrificing, 1.8. The indexation almost nobody updated their videos about isn't a detail. It's the whole answer. And so you don't think I'm waving this away? Here's the version you were originally told about, as a ghost on the same chart. Frozen 3 million line, never indexed. Sarah's hot returns projection punches through it at 59. 1 year before she can even touch the money. Base case, she lands within 230 grand of it. Under the original draft, this genuinely was a future problem for today's 35-year-old maxer, which is why the coverage was so loud and why it's now so misleading. The scary version existed. It just didn't pass. And that hands you a test for every other video in your feed. By the way, if their coverage of this tax doesn't mention indexation, this ghost is the law they're describing. So, what would it actually take? Start at 35 with 400,000 already in super, triple Sarah, and compound at the hot rate, maxing every year, 5 million at 60, still under the line. On today's law and reasonable assumptions, a salaried 30-something essentially cannot save their way into this tax through capped contributions. The caps themselves are the ceiling. Kidit. So, who does it find? Here's the part actually worth remembering if you're under 50. This is not a tax on saving, it's a tax on lumps. The inheritance that lands in your 50s, and Australia is midway through the biggest wealth transfer in its history. The business sold and rolled into super. The self-managed fund whose property revalues sharply. A salary can't carry you over that line. A lump can do it in one afternoon. Today it finds people already near the threshold. The official year one estimate is around 90,000, roughly 0.5% of Australians. But the reason to understand it now is simple. Lumps arrive on their own schedule. One more design detail that changes how you should read every headline about this tax. The threshold is per person, not per household. A couple where each partner holds 2.9 million pays not a cent of Division 296, 5.8 million in the same house, untouched, while a single with 3.5 million is over the line. Play that forward with indexation, and a couple effectively carries nearly $12 million of combined headroom by the time today's 35-year-olds hit 60. Two practical readings, both factual. For couples, contribution splitting and keeping balances even isn't just an estate planning nicety anymore. It's the difference between two thresholds and one. For singles, every projection in this video is your balance against one line, so the single saver is the first person this tax would ever find. Neither of those is advice, but it's exactly the kind of detail the headlines skip, and it moves real money. Before the caveats, one date that is real. The first test is your total super balance on the 30th of June, 2027, across all your accounts combined, not per fund. For almost everyone watching, that's a non-event. But if you're anywhere near the line already, a big SMSF, a business sale rolled in, an inheritance landed in super, that balance date is worth knowing about now, this financial year, with proper advice. That's the group this tax was actually written for. Now the honest caveats, because not your problem by 60 is a projection, not a promise. The indexation that does all the work in this video is a line in legislation, and legislation can be amended by any future parliament. The two-tier design, 30%, then higher, now exists as machinery, and machinery tends to get reused. And this model is a salary earner with capped contributions, a business sale rolled into super, an inheritance, an SMSF with a property that revalues sharply, different lanes, different maths. The law that passed is much milder than the draft. It's still a real tax, and the direction of travel is worth watching with clear eyes. The verdict then. On the law as passed, with stated assumptions. A 35-year-old on a good salary, maxing super for 25 years, projects to less than half the indexed threshold. This tax, today, is a watch item for her, not an action item. The version that would have caught her is the one that didn't pass, and the numbers most of the internet is still quoting belong to that dead draft. That gap between what passed and what people think passed is exactly the gap this channel exists to close. That's the projection, and every assumption behind it is on screen, so argue with the inputs, not the vibes. If you want more Australian money questions run properly through the numbers, super, tax, property, the lot, subscribing is the one-click way to keep them coming. See you in the next one. No.